don't even know what money is and any longer. There's so many things that function as money that we can't really measure the global supply of it. The derivatives market alone aggregates to something like a quadrillion dollars notional value. All right, so you've got all these debts, and we're pretty much agreed, unless we're deaf, dumb, and blind, that they're way beyond payable.
In the 1990s, he created $1 billion copper producer. In the 2000s, he launched what would become one of the world's top primary silver producers. And in 2015, he started what he believes will be his third billion-dollar company. This is the one gold stock to research right now. Visit crushthestreet.com/investright.
Hello, everyone, and welcome into crushthestreet.com. I'm joined with a new guest today. Actually, not a new guest, a returning guest. He's been on the show before, and just excellent insight, amazing analysis. His name is Rick Ackerman. Barron's once labeled my next guest as an intrepid trader. And he's been a contributor to many publications, spent years as a market maker, and has even spent time as a San Francisco private eye investigator. Rick Ackerman is the editor of Rick's Picks, and his website is rickackerman.com. Rick, thanks for joining me.
Thanks for having me on, Ken, and also for the glowing introduction.
Well, that's my job here, Rick, and it wasn't short of the truth. So, Rick, do you think the Fed knows what they are going to do with the rate hike decision tomorrow? And would you say that the volatility we are seeing with gold spiking and also just the markets, what we are seeing right now is simply telling the Fed that they can't raise interest rates?
Well, the Fed's been kind of making it up as they go along, and I think that the impression you get that there's such reverence for the Fed and the things that it does is that they're very much overrated. They don't know what they're doing any more than you or I would in the same job. So they've kind of painted themselves into a corner here with the idea that they've got to walk the walk by tightening a bit, but the fact is the economic recovery that supposedly has been taking shape since 2008 is not really strong enough to weather too much another turn of the screw on administered rates.
Do you think they're literally making it up as they go along, and so they'll just kind of see how the markets do tomorrow and kind of go from there, or do they have some sort of idea of what they're going to do?
Well, I think it's worse than making it up as they go along. They don't seem to be learning from, for one, Europe's failure to monetize. Europe has gone negative on interest rates, and you've got fairly risky bets in terms of bond yields that go out 30, 40 years where your yield is less than 2%, less than 1% actually. So a fat lot of good it's done Europe, and we can see that even here in the U.S., monetization works somewhat better because our economy is hardwired to consume. So when interest rates ratchet lower, we instantly actualize that, I guess would be the word. We put it right away into cars and durable goods and all sorts of consumer gewgaws. But Europe is not, that the consumer mindset doesn't dominate there. So I think we do a little bit better with cheap credit.
Rick, you have been on record saying that you believe that the bonds are going to go lower. That the rates on these bonds are going lower. And how does that work with potentially rising the Fed funds rate? Do you still believe that these bonds will go lower just as a reaction to the markets?
Well, in the first place, raising the administered rates is difficult. They're not really achieving any market tightening because there's too much money, for one, in the money market funds. There's so much money jangling around out there that as a practical matter, tightening is difficult to impossible. But, as far as the long-term rate, I think it's a great bet that it's going lower. Because it goes against a huge consensus. You got all the smart guys, Bill Gross, Warren Buffett, they're all kind of lined up thinking interest rates have to go higher. And it's easy to see the logic of that. You know, the rates have come down from an inflation era peak of 15% to recent lows down around 2.4%. So you look at that and you think, well, geez, you know, rates have fallen so far, that how much lower can they go? Most of the falling that could conceivably occur, that could mathematically occur, has already happened. But so that's why virtually everyone is on the wrong side of this bet. But if you take the current rate, the 30-year, as I speak, is yielding 2.41%. And, of course, yields vary inversely with the price of these bonds. So it turns out that if you get just a small downward move in long-term rates, it has a correspondingly huge effect on the price of the vehicle you own, which could be, U.S. zero coupons. It could be long-term muni strips. Those are excellent vehicles for being the long end of the yield curve. So if rates, my forecast, I've been essentially shouting this one from the rooftop for the last couple of years, is 1.64% on the long bond. And if that were to occur over, let's say, the next 18 to 24 months, the corresponding capital gains in the zeros or the muni strips that you might own would be on the order of 20% plus per year.
Mm. Would the interest rates falling like that, would that stimulate some growth in the economy with, more borrowing or, housing, what that would do to housing, stocks, and any implication as to what you are, predicting to happen with these bond yields falling?
Well, I think we've already got the max benefit out of lower rates. It translated into an 18 million unit year for car and truck sales, and that may be a peak that stands for a while. And also, coming out of the 2007-2008 great financial crash, the most significant effect of easing had to do with the mortgage market. Essentially, everybody who was mortgaged at 5.5% got to refinance down around 3%, and that was very, very important with respect to household liquidity. And more than anything else, I think that's what took us, at least nominally, out of the 2007-2008 wallow. But we haven't achieved too much more than that. We've had subpar growth since, and there's really a question of how much more you can stimulate the housing market if interest rates come down further. And as you can see, even at 3% mortgage rates, that can become a crushing burden if the underlying collateral, which is to say the value of your home, is falling as it did during the 2007-8 period by 30% plus. So, to think of the 3% mortgage is great, historically very low. It's going to be suffocating if the home prices themselves are falling.
Yeah, no, I could only imagine where we're at. I mean, the breaking point of the whole market right now is just, we're there. So, the high prices, breaking the backs of the American consumer, rising interest rates could do it, the crippling unemployment, slowing down of the economy, just so many things that are out there right now. But, we touched on Europe briefly, but, the market seemed to be very concerned on whether or not there will be a yes vote for the BREXIT. And my question to you is, does the BREXIT really matter, in the grand scheme of things, if Britain does exit the Eurozone, or is it really more of an acknowledgement that the system that is in place is failing?
I see no significance whatsoever to Brexit. It's understandable that the bureaucrats in Brussels are out there proclaiming that it will be the end of the world if Britain exits. And, of course, it's the chosen role of the news media to report the conventional narrative without ever doing any digging or even thinking about the story. But, Britain's exit, first of all, they're not even part of the euro currency alignment. They still use British pounds. So the key aspect of the European Union really was to unite the continent, unite Europe under one currency, essentially to put a currency in place that would simplify transaction costs, and it would put everybody on the same page, so to speak, with respect to trans-border trade. But, all right, so Britain hasn't been in the currency system to begin with, and the main piece of it, where it plays best to the British voters, is that it will give Britain more control over immigration policy. That's really the stickiest issue for most Brits. And, when you see what's happened across the continent with respect to open borders and the migration you've had from Syria, for one, it's hardly surprising that Britain wants to be able to make its own rules. So I don't see any significance at all to Britain's exit. It's not going to change things. If it has significance down the road, it's only because perhaps it started a slippery slope effect where some of the other countries that are feeling more and more trapped by Eurozone rules are going to think, geez, if Britain could escape, maybe we can too.
Rick, oil has nearly doubled off its lows from earlier this year. And, it would appear that rising oil prices has been directly correlated to a rising stock market. And even today, oil is down, and so are the markets, although I think a lot of it would have to do with just fears of the BREXIT and, the rate hike uncertainties. But, of course, having to do more so with a fundamentally unstable global economy. But as for oil in the markets, has one been dependent on the other here as of lately?
Well, the stock market has been led by the nose by crude oil prices lately, and for good reason. In the wake of the 2007-8 housing bust, the bankers had to figure out, well, what are we going to hawk up to our eyeballs next? And the best collateral, what they settled on, was energy resources. So the global financial system, the banking system, the banksters, they're all in with respect to energy sector loans. So it's no shock that they should want to see higher oil prices. But my gut feeling, and also my technical idea here, is that the entire rally in using the NYMEX crude contract from $27 up to a recent $51 and I think it was 67 cents is just an enormous dead cat bounce. And from a technical standpoint, we had a target that was pretty important on my longer-term charts at 51.49. That was basis the July NYMEX contract. And as oil was rising, I was bullish, but only into the low to mid-50s. And the reason I think that we've had a dead cat bounce and the price of crude is capped is because the story, the bullish oil story, it's very strange this time. It's basically a supply-side story, meaning, geez, oil prices could rocket higher if there were some major disturbance in Venezuela, as though Venezuela weren't disturbed enough already. But the scare story to push crude prices higher is that there could be a supply disruption from a major source such as Venezuela or Nigeria, where the output has been slowly falling. But a true bullish story, if the picture were really bullish in oil, it would be driven by a demand-based story. In other words, China's economy is improving, and India is starting to get traction economically, but it's not. No one would even believe that we're getting into some big growth period for the world that's going to put pressure on oil supplies at the margin. The biggest energy buyer at the margin is China. China really sets the price, and China is in a wallow right now and just getting worse.
Rick, we know that negative interest rates are hurting, especially the European banks, and we know that central banks like inflation. And you are forecasting, and you've been a big proponent and on record saying we're going to have deflation. And I want you to reiterate how you see deflation trickling into these markets and what we're going to see as a result.
Well, the huger the pile of debt that you stack up, the more likely deflation becomes. Deflation essentially means a strong dollar, implying that everybody who owes dollars is going to be increasingly challenged to pay them back if we have deflation and the dollar increases in value. And one thing, the rule of monetarists is that they take a very simplistic picture of inflation, deflation, and they say, or they have always said, that inflation is an increase in the money supply or in a particular currency, or deflation is a decrease in money. And that way of looking at it has really become obsolete for a couple reasons. We don't even know what money is and any longer. There's so many things that function as money that we can't really measure the global supply of it. Let's just say that the derivatives market alone, which is denominated mainly in dollars, aggregates to something like a quadrillion dollars notional value. All right, so you've got all these debts, and we're pretty much agreed, unless we're deaf, dumb, and blind, that they're way beyond payable. And I'm including liabilities that arise from the Social Security system in the U.S., from private and public pensions and everything else. So we owe a heck of a lot more than we can ever pay. And my suggestion for anybody who wants to understand deflation is to see it in terms of its chief symptom, which is an increase in the real burden of debt. And there's no way we're going to escape that. We can try to do it by monetizing, which is, we've all seen, pumps up the financial sector. It pumps up stocks and bonds, and we get financial asset inflation. But where the rubber meets the road, in one instance, a big case, Social Security and pensions, there's no way to monetize that. These are basically checks that get sent out every month to retired workers, and you can't simply print money to meet those obligations. As you can imagine, it would create political problems as to who continues to get their pensions and who does not. So that is a deflationary overhang, and as is healthcare. The Medicare system alone is going to exert a huge deflationary pressure on the U.S. economy, because it's not something that can be inflated away. It's deflationary in the sense it's going to have to be taxed out of us, out of people still able to pay taxes, to pay for the benefits of people who are retired. So that's very deflationary. And the last piece of it, or at least one very important piece that should also be mentioned, is the housing market. We've all borrowed to the hilt to buy houses, and if you watch the Home Garden TV channel, you'll see that just average schmucks are buying $800,000 homes in California, and they're not people with fabulous jobs. They have good jobs, but they're only buying $800,000 homes because the banks are giving them money to buy them. But when you figure how long it will take to pay back a mortgage of $500,000-$600,000, these people are in hock for the rest of their lives. And someone needs to tell me, someone who believes that we're going to have inflation, needs to tell me how real estate is going to settle out in an inflationary way or hyperinflationary way, because that implies that the homeowners all mortgage debtors are going to skip and go naked. Basically, in a hyperinflation, they'll be able to pay the balance of their mortgage with the kind of cash people will be carrying in their wallets at that point.
Well, you're describing a situation that is essentially the U.S. is up against the wall. The global, all the countries are up against the wall. They can't tax their citizens anymore. They can't borrow. And, and you're saying they can't print. But in individual circumstances, we have seen countries resort to printing. You're saying that they won't. And because they won't, we'll see deflation. But, the extreme example, Zimbabwe. They can't borrow, they can't tax, so they print. Argentina can't borrow, can't tax. they print. Yugoslavia, same thing, can't borrow, can't tax, so they print. But if they don't print, you're saying we'll see deflation. How come you're so sure that they won't print our way out of these problems? I know you're saying that they can't. There wouldn't be a good environment if they did, but they're also out of options.
Yeah, well, Zimbabwe's currency is not the global reserve. It's one thing to inflate Argentinian pesos or the Zimbabwe currency or whatever, but you're talking about small potatoes. It's nothing compared to trying to hyperinflate the dollar debt into nothing. And for anybody who thinks that the helicopter money solution is possible, I would strongly suggest that Ferguson's book, I think the title is The Day Money Died. It was out of print, and it talks about the Weimar hyperinflation of 1921-23 in a way that absolutely illuminates why the same thing cannot happen here. The German hyperinflation required mass collusion between the government and the unions, and the German economy, the workforce, was very much unionized in the period following World War I. The actual inflation took place because physical dollars were sent to the big employers in railroad boxcars. And one irony of the German hyperinflation was that in that period, 21 to 23, the worst part of the hyperinflation took place when the government printing press guys were on strike. Germany wasn't even printing Reichsmarks, but there had been an agreement in place between the major employers and the government that if the boxcars full of money didn't show up, the employers could issue their own scrip. So, the larger problem even is in a hyperinflation, who wins and who loses. The government will certainly not be bailing out people who have fixed income from, Social Security for one, but any pension plan for two. So the instrumentality of hyperinflation is not there. And to put it right at the level of something that could actually happen, let's say the banks don't open one Monday because there's some conflagration in global financial markets. No event could be more deflationary than that, than the banks won't open for a few days. Because if we line up outside the banks, you're going to discover that the branches don't keep more than $20,000 to $30,000 of cash in their vaults. So if there are 50 people lined up, maybe the first two will get their money, but probably not even that. And so if you have that situation where the banks don't open and there's no cash out there, we could not possibly resort to a credit card system where the government says, well, we'll get the cash to you in a week, but for now use your credit cards, because the whole clearing system that makes the plastic economy, the digital money possible, is based on trust, which I would say is egregiously misplaced. So the problem of trust is going to cause the credit card system to collapse, and that's why I tell all my subscribers that besides whatever gold doubloons they've got buried in their backyards, they better have a shoebox full of 5s, 10s, 20s, and 50s, because that's still going to be the coin of the realm.
Rick, so also what you were alluding to earlier, and I'll word it this way, is the global currency wars. And you were saying that basically foreign currencies are going to fall quicker than the U.S. dollar. And that, again, is deflationary in relation to what we're going to see around the globe. So, again, how does this trickle into what you're expecting to see in gold and what you're expecting to see in oil as well? Do you see oil going lower because of deflation, and do you see gold going lower because of deflation?
Well, I could see gold and oil going their separate ways. I did characterize the rally in crude as a dead cat bounce, and I think that crude there's speculative demand for crude to the extent that the speculators think that the supplies of energy will be used, that there will be big economic demand for it. But that's not going to happen if we go down the toity. But gold, on the other hand, I think will do well. I'm not in the hyper bull camp that sees gold at $5,000 or $10,000 or $50,000 an ounce. In order to believe those prices, you have to think that the regulators are going to effectively say, okay, all you big bullion bankers, J.P. Morgan, Goldman Sachs, all you guys who are short up the wazoo in gold, you're going to have to make good on your commitment. You're going to have to issue, you're going to have to provide physical gold to all these, to Joe Sixpack, who's got an ETF that says he's entitled to X amount of gold. So I don't think there will be a short squeeze on gold for that reason. It would favor the little guy over the big institutional players who, on a carry trade, are always wanting to be short gold. So, but I can absolutely guarantee you that whatever happens, whether we go into a hyperinflation or a deflation, that gold will hold its purchasing power about as well as any financial asset out there. So, which means we could have gold at $500 an ounce, but the buying power that might command would be, would be commensurate with, any other asset that's held up well over a catastrophic period. So I think it's always good to have some of your assets in gold because it's really a come hell or high water asset.
Rick, it was a pleasure talking with you today. Do you have any last words of just closing words of wisdom for the audience that you'd like to share?
Well, it's not complicated. I would say that this bet on long-term interest rates falling is, I'm not going to call it a no-brainer because there's certainly some decent arguments you can bring against it, but I think it is an enormous opportunity. It's definitely going against the consensus because, they're all thinking rates have fallen from an inflation era high of 15% down to 2.4%. How much lower can they go? But my forecast is 1.64% on the long bond, and I think it's just a fat pitch. It's a great place to put your money, and I'm pretty confident about it.
Rick, if people want to reach out to you and learn more about what you do and the work that you do, where would they go and what would they find?
Go to rickackerman.com /money trends, and you'll be able to get a free trial subscription to Rick's Picks. That will get you my daily actionable trading counts, but also access to a chat room that goes 24/7 with some of the best traders out there. They're really a strong bunch of traders, very helpful bunch of men and women. And if you sign up there, we'll put you on a list for a free copy of an ebook I'm going to have out shortly on my trading rules. So again, that's rickackerman.com /money trends.
Rick, I enjoyed the conversation today. A lot of amazing insight, and thank you so much for coming on the show.
Well, thanks very much for having me on, Kenneth.